Hello and welcome to the special education edition of Options Guy TV. We're going to talk about the skip strike butterfly mechanics. And I want to get into how a skip strike butterfly becomes a skip strike butterfly and why did I name it skip strike butterfly inside my book as opposed to going with the standard modified butterfly or broken wing butterfly. And I want to get into those details. So I thought I would take the time today to walk through how to set up a skip strike butterfly and look at a real example today on a company that's going to be announcing earnings soon. As a matter of fact, they're going to be announcing prior to this video actually being released, and that's going to be in Broadcom. So we'll look at a real life example with real quotes and see how we would set up a skip strike butterfly on a very volatile stock. All right, so with that said, you have four basic option positions as far as all strategies are concerned. And in this situation, we're going to be combining a couple of purchases of a call option with a couple of the sells of a call option. So in this instance, we're going to look to sell a credit spread to pay for a butterfly, and that's going to make up our skip strike butterfly. So let's start by looking at what a butterfly is. And we're going to really concentrate on the profit and loss graph. We got the max risk, max reward, and the break evens. But what happens with the butterfly is that you pay a net debit, and that debit is your risk. Now, if the market it finishes below your lowest strike on the call butterfly, you can lose the maximum, the net debit paid, or above, you can lose the maximum, which is the net debit paid. The nice thing is that it's not a lot, right? It's usually quite cheap to put on a butterfly when you put on the three legs. Now you have solid upside, but that's upside only happens at expiration. You want to be wary of that. But the risk versus the reward, if it were to go out right at your center strike of your butterfly, is a real nice risk reward situation. All right. So we have this nice butterfly, this nice little situation, but a lot of people love to do vertical spreads. They love to sell spreads for a net credit, especially when volatilities are up a little bit and you can get a little bit more premium for selling your credit spread, or what I call here bear call vertical spread. So once again, we're going to focus on the call side of things. So if I sell a credit spread, I bring in a net credit, and that's my maximum profit, right? It's limited, it's known, it's exactly whatever I receive as a net credit is my maximum upside. On the downside, it's the difference between the strikes, right, minus that net credit received. And that's our maximum loss on the trade. It's limited and known, but it's much more painful on the loss side of things. There's a lot more red over here than there is green on this side. All right, so we have one of the favorite strategies out there that a lot of people like to do: sell vertical spreads, either on the put side, means you're bullish if you sell a put vertical, or on the call side, and that means you're bearish. Now, let's combine the two, because it's hard to get the maximum out of a butterfly, and it's easy to get the maximum out of a bear call vertical spread. All right, so let's take that spread and buy a butterfly, and that's what we're going to look to do here. So it's a combination of the two, and a lot of people think of a butterfly or a skip strike butterfly as an alternative to a butterfly. And I say, no. It's an alternative to a short spread. It's an alternative to a short vertical spread. If I sell that vertical spread, I bring in a lot of premium, especially when it's a volatile marketplace, when you have a known event, or just the way the markets have been recently, you have a lot of volatility in the marketplace. So you get extra premium for selling your short vertical spread. We're going to take some of that extra premium. We're going to buy that butterfly and basically embed the hedge of our trade right in the trade on the initial beginning. We're not going to leg into the butterfly. We're not going to do it. We're going to put this whole gaggle of securities together, and it just makes us easier to be able to manage it. But we're going to have to give up some premium to do that. So we're going to combine that butterfly with this bear call spread. This strike is the same. This strike is the same. And this is where I get the skip strike from. You're buying this strike on this call butterfly, and you're selling this strike on this bear call spread. So why not just skip it, right? That means you're betting the butterfly, the bear call spread, and the margin requirement and the risk of that bear call spread into your butterfly. And guess what it looks like? Here's our skip strike butterfly. This is the risk from the short spread. This is the benefit of the butterfly. Now, if you get this all done for a net credit, here's what's wonderful is that if the market is below your strike on your butterfly, you're still profitable. You're doing a butterfly for a net credit. You have additional risk, but this is the trade-off. So a lot of times when you're doing these trades, the market is way down below the first strike that you're going to buy in that butterfly. And you're hoping that the market stays that way and goes south. Because if it does, you receive the net credit, just like if you did the bear call vertical spread. As far as the lineup is concerned. So I always so here's the moral to the story. I always like to think of skip strike butterflies as an alternative to a short call vertical spread. The trade-off is the amount of premium that you're going to receive to put on that trade. And to show you that, let's back out here and let's go and look at the Tradier Pro software. And let's look at an example. And we talked about this on Options Guide TV on Wednesday. And let's go back to the Tradier Pro software. And in this on Wednesday, we noted that Broadcom, a very popular semiconductor stock, is announcing earnings on Thursday after the close. Now, we're taping this on Wednesday, but I thought I would put together a Broadcom longer term skip strike butterfly as an alternative to a short spread. So if somebody was thinking about selling a short spread, around an earnings event, a lot of times you want to be very particular about the range that you are choosing. In my instance, I'm going to go out to the 20th, June 20th expiration. So if we send this to our option chain and we look at this trade, we're going to try to get this trade done for a decent net credit to the account. So what it has done is the stock is here. Company's going to announce earnings. Volatility is elevated. We're going from 260 all the way up to our first strike is 285, 25 points out of the money. From 285 to 290, we're still safe, right? That's from this range to this range. But then as we continue on down, now our short spread kicks in, and that's our remaining risk. Now, just like on a short spread, I want to highlight here, and I'm going to scroll down here a little bit, make it more distinct, is that when we first put on this trade, the green line represents the risk. So if it goes to our short strike right away, as soon as we put the trade on, we're hurting. We're hurting on the short strike of our skip strike butterfly. But as soon as that earnings announcement happens, implied volatility comes in, these option contracts start withering away, and this line eventually morphs into what the skip strike butterfly looks like at expiration. So it's not a perfect trade. It's not as beautiful as it looks at expiration. It takes some time, but no matter what happens, if we do this trade, it's going to benefit us to have a long call spread in here to offset some of the risk of that short call spread in our trade. So I'm going to run now to the actual grid, and we're going to look at this trade and consider what we would have done if we were just selling the short call spread. Okay, we buy the 285, we sell two of the 290s, we skip the 295. That's where our short spread kicks in, and then we buy the 300. So in this instance, the 295 is trading for, and I'm just going to look at the bid here, right? $2.66. And the one that we would buy would be the 300, and that's $2.10. So 56 cents is the net credit received with 5 points of risk. We do this trade, and guess what? Because of the volatility, and that does have a lot to do with, so I want to emphasize that we know that there's an earnings date. We can get this done for 40 cents. So the butterfly costs about 15 cents in this trade. And if you did that trade, you're like, well, why don't I just buy the butterfly and just pay 15 cents? Then it's got to stop right in the middle, right? It's got to land within that real small range on a $290 stock. So I don't like just buying the butterfly outright, but I don't mind this and doing this trade and having a small hedge. I'm going to give up a little bit of my profit potential to have a hedge that's going to offset me, that's going to get better as expiration approaches. I hope you caught all that. Might have to go back and watch it again. My name is Brian Overby. I'm known as the options guy here inside the Tradier Hub, hub.tradier.com, if you'd like to learn more about all these different strategies. And we'll back out here in just a little bit, and I'll show you some of my data. My book is the Options Playbook, and my handle inside the X.com platform is at Brian Overby, if you'd like to know what I'm doing. Options Guy TV is every Monday, Wednesday, and Friday at 11 a.m. Eastern Time inside the Tradier Hub. And I want to thank Tradier for sponsoring this event and all the great speakers. You can find them all at hub.tradier.com. Hope to see you in the Hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.